So good morning, everyone. Welcome to the annual July program hosted by Frederickson and Byron. This is set up to be another great panel. But before we get into that, just want to talk briefly about AdFed for those that are new to AdFed programs. AdFed's a nonprofit professional trade organization that serves the advertising community at large. And we're we've been in the community for over 110 years, kind of formed out of the Better Business Bureau. And we're part of the American Advertising Association, the AAF, which Clark, what's his first name? Director. Yeah, Clark Rector spoke last July on the taxation issues facing ad agencies. But some upcoming events we have for AdFed and Ad2, and Ad2 is geared towards 32 and under within AdFed, but we're all kind of under the same umbrella. Upcoming events are the Summer Internship Panel, Season Kickoff with Silver Medal Presentation, the Media Panel Luncheon, and the Women's Leadership Panel. And then you can go to adfed.org/events for the full schedule throughout the year. Would like to thank all of our annual sponsors, Frederickson and Byron, Digital People, Goodway Group, Pictora Graphics, Irish Titan, Twin Cities Business Monthly Magazine, and Modern Promos. Without our sponsors, we can't put on events and gather the great content to deliver to everybody. So today the program is called Agency Valuation and M&A Cycles and kind of the unspoken impact on businesses and employees. So as agencies, we're always looking for ways to maximize our market value and position ourselves for either a large sale or a buyback position, both which can have an impact on the daily agency life. So during this panel discussion, we'll look at what contributes to a successful corporate transaction and kind of how these deals influence the company culture. So without further ado, I'd like to introduce our moderator, Courtney Thompson, who has graciously donated her time to be the moderator for this discussion. So the floor is yours. Courtney, thank you.
Thank you, Craig. Oh, good morning, everybody. My name is Courtney Thompson. I'm in the Advertising, Marketing, and Trademark Group here at Frederickson and Byron, and I'm also on the board of AdFed, so heavily involved in the group and really excited to have you here today. With the acquisition of agencies, particularly by publishing companies, being one of the biggest trends in the M&A market in 2016, we thought this is appropriate time to hold this topic here today and talk about corporate transactions that involve agencies. According to some stats, and our very knowledgeable panelists might correct me here in a minute, but I found that it was nearly 400 M&A transactions were reported that involved agencies last year alone, totaling over $14 billion. So the really objective of our time here today is to share some thinking about factors that contribute to the decision to sell, valuation, and impact on employees. Before we get started, just going to do a quick poll of the audience to get a feel of the room. So if you could raise your hand if you currently work at an independent agency. All right. And if you work at an agency that's owned by a parent company? And you own an agency yourself. All right, great. Well, that will help us today as we go through some of these questions. First, a quick introduction of the panelists themselves. We have Lisa Miller here, who is the CFO of Colley McVoy. She summed up her job pretty nicely when she says, if it has anything to do with finances or infrastructure, Lisa is on it. So there we have that. We also have Ryan Brower, who is a shareholder in our securities and M&A group. He has over a decade of experience handling all sorts of corporate transactions. We have Keith McCracken from Liverpool, England. He founded Minneapolis-based agency McCracken Brooks, and it was named Agency of the Year for 3 years in a row in the 90s. And he was also inducted into the Hall of Fame of Marketing Agency Association Worldwide, which is a nice accomplishment. And then finally, we have John Pickerel, who's a shareholder in our Advertising, Marketing, and Trademark Group with a specific emphasis on social media legal issues. So with that, we will kick off the program, and I'll direct the first question to John. I'm wondering if you can give us an overview of the current landscape of M&A transactions that involve agencies and your opinion of whether it's a buyer or seller's market.
Well, anybody here can feel free to chime in. I think what I've seen over the years is that it's sort of evolved, the M&A transactions. They've been very important in the industry for decades, but it used to be just the mega conglomerates that were buying up sort of bigger agencies. And it seems like now, as we've gone more digital, and after the big crash, 2008, that the agency world kind of changed, and we went to a model of sort of the giant agency model was blown up a bit, and we ended up with a lot of smaller, more strategic, specialized function agencies that did a lot of different things. You know, you've got analytics specialists and people in SEO and just digital specialists. And so it seems like there's a lot of smaller agencies out there that are now being bought up as people are looking for that specialty. And they're being bought up by different types of entities. You know, it's not just the big conglomerates anymore. You see businesses taking certain functions in-house so they don't have to outsource it anymore. You see a lot of medium-sized agencies looking for some specialty that maybe they currently don't have, and so they're acquiring people. So it almost seems like it's a quantity approach now to where there's a lot of smaller transactions and a lot of different people involved. But I'd be interested if you guys have seen different trends or have different thoughts on.
Hand that one, Keith.
I have. Well, I think I would agree with what you've said so far. You know, the fact is that the public companies in this space, so the big holding companies you referred to, and some of the smaller ones, are under pressure from their shareholders to grow somewhere between 10 and 15% a year, and that's not possible in this industry anymore. And so buying other agencies, buying businesses is the only way to do it. I remember talking to the head of M&A at WPP not long ago, and am I switched on? Maybe I should sit forward. Talking to the head of M&A at WPP, and they need to do about 50 deals a year in order to meet their expectations. And it used to be that there were 50 chunky agencies they could acquire. That isn't the case anymore. I think if you work backwards, the number of agencies doing more than $60 million a year in revenues is this many in this country, 5. And that's what they used to aim for. There used to be lots of them. Agencies doing more than 20 million, there are probably 40. And then the rest. And so consequently, what you're seeing is the holding companies, the consulting companies, the entertainment companies, the publishers, the vertical integrators, and the people taking it in-house are out there peddling around smaller agencies, and it is very much a seller's market.
Yeah, just to kind of round out that, and Keith addressed it at the end, and I, you know, from my perspective, I think to a certain extent, it's both the buyer's and the seller's market right now. For us, that do just you know, one M&A transaction after M&A transaction, the last 5 years have been, you know, the best 5 years I think that we've seen since maybe, you know, the early 2000s. But it's a great time to be, I think, either a buyer or a seller. From the buy side, I think access to capital and relatively inexpensive capital remains strong. As Keith mentioned, there's a good amount of pressure for some of these companies to buy from the sell side, and there's a lot of capital to be deployed. Some of the unconventional buyers that have entered the industry, including private equity, which for years sort of you know, the private equity likes hard assets and EBITDA and the hard assets that they can leverage. And obviously with a lot of these industries, you don't have that. But from the sell side, you know, we've seen multiples, you know, remain very strong. So I think it's a good market, continues to be a good market on both sides of the equation.
And so a few of you addressed in your answers kind of the size of target agency that is desirable. Is there also a specific industry or niche that these agencies are in that seems to be a particularly hot area? For example, digital or ad tech companies?
Keith, you want to?
Yeah, there's a definite preference towards the types of services offered. If you go back to the point I was making, that there are fewer large agencies out there, but actually what also is happening in conjunction with the sort of frenzy to find growth in the agency industry, there is now a desire to find the right strategy to meet client expectations. And so analytics is probably the most valuable or highest multiple right now in terms of the skill set that is being sought. And I say analytics, I mean the sort of full service CRM agency. Ad tech is declining a little, but only because it was overpriced. Ad tech and analytics are the two hottest areas. Mobile is critical. But I would say there's a sort of line, it's the digital line. Anything above the digital line, any sophistication on top of digital are the most sought after targets.
One of the things that we look at a lot of times too are unique service offerings, things that as you get to be a larger agency, it's actually harder to create something than it is if you're a more agile, smaller agency where you have people that have multiple skills. When you get in a large agency, we tend to take somebody who's got a diverse set of skills and we say, no, we just need you to focus on this one thing. We just want you to be media. We just want you to be strategy. And so one of the things that we always appreciate, and we love to hire people from small agencies, if we can't steal the talent, then we buy the company, is that you have that diverse skill set. And that's something that we're very aware that we tend to try to put people within driving lanes. When actually the most valuable resources and the most valuable organizations are ones that have these great breadth.
I think that's a nice transition to talk more about the employees at independent agencies versus agencies that are owned. That speaks to some of the skill sets and personality types that might fit better at one or the other. So Lisa, if you could just speak a little bit more too about the personality traits and strengths that are important for each.
Well, you guys are in the biz, you get it. I mean, you need we need diversity in background, we need diversity. So we don't want everyone just from the Midwest. We want people that have come from different places. We need diversity in life experiences. We need diversity in gender, in ethnicity, in whether you're English speaking is your primary language or another language is your primary language. So our business is seeking that more so than I think any other business. So as far as what person fits, I honestly, right now, one of the hottest things that we're struggling with in Minneapolis is if you are a farm kid, that is one of the golden tickets on your resume. I mean, we cannot find enough people that actually understand the difference between straw and hay, or the difference between wheat and oats. So and those are things that, I mean, yeah, you can train, but it takes years to train. So who would have thought 10 years ago that being a farm kid was going to be a hot ticket on your resume? But we're paying those people 20 and 40% premiums because we just need them so desperately. So I can't say one type of personality. I can say within a larger company or a company that's part of a holding company, you're going to have a lot more discipline in your processes and your reporting structure and your forecasting. I always make a joke to my parent company that if they wanted predictability, they shouldn't be buying advertising agencies. But they are subject to the market pressures, and therefore that trickles on down to different organizations. Within smaller companies, the smaller organization that is still founder operated, founder managed and owned, those are having more difficult time. We've acquired multiple companies, rolled them in. We've had some successes. We had one that was a failure, and we had to go our separate ways. We had to have a merger. What do you call a divestiture? A divorce. And so, yeah, divestiture. And so because of those things, what we found is the ones that are still really near, that the founder owners, we really need to find a way to transition that to that next generation management, because that's where the value comes from acquiring. So if there's a unique skill set or a unique offering or a unique service, if they've got heavy analytical skill set in their employees and have been able to institutionalize it, that has a high value to us versus you just have this one really cool employee, but that cool employee could take off for Amsterdam the next day. And we literally had an employee take off for Amsterdam the next day. And so then all of the value in the company disappeared for us. So the experience from an employee standpoint, when you, in a larger organization, you will have a lot more people to clear things through, whereas before you might have just had to go down the hall and there was that one person that could sign off on everything. So that makes it a little bit different. It's a culture change. Or the free soda, you might now have to pay for the vending machine. And those are the weird things that really trip you up. It's not the big stuff you think about, it's the little stuff. It's the where you put your coat and whether bikes are in the office or you can bring your dog to work. That's the stuff that really culturally, when you're merging the organizations, can cause a lot of tension.
Lisa, I'm a Nebraska farm kid, and
There you go.
I'm not positive I know the answer to either of those questions. But I like the premiums that you were offering, so we should talk.
This is a good time to be a farm kid.
And John, you had experience in the agency world before transitioning to law. What is your perspective?
Yeah, I was at Carmichael Lynch for a little over 5 years before law school, and I was there when they were acquired by IPG. So I saw the earlier side of an independent agency, a smaller sort of quirky agency, like you say. We're having minnow races and bringing dogs to work and doing all these kind of things. And they used to have this philosophy of Carmichael did not want to work for the number one brand in any industry. They wanted the number two brand because they were hungrier. They let you do better creative. Their premium was always on top-notch creative. And then once IPG bought them, you felt the shift after a while that it was more, it was now profit-driven. Yeah, and they paid better once IPG bought them. I mean, that was part of the trade-off. I think IPG came in and said, "Holy crap! How are you keeping these people here, paying them what you're paying them?" So everybody kind of got raises very soon, and so that part of it was good. And there's an administrative layer that was applied to everything because they took the IPG systems and brought them in, and so it was probably a lot more professional operation, but you lost some of that homegrown sort of family feel, the independent feel that I think appeals to a lot of people, and I think some were happier with the life after IPG. But now I've always wondered, Cole McVoy, historically was a very strong ag agency, and that's where they were thought of until, about 20 years ago, maybe less?
Yeah, I'd say about 15 years ago, things really switched. We still have a legacy in that area, and that's a Minnesota thing, where we still represent, here in the Midwest, we still have a heavy agricultural influence in a lot of our marketing. But that's a much smaller part of our business now.
Was that pushed from?
No.
Oh.
No, it was just the way, you follow your clients, you follow the paths. It was a desire to diversify, so if agriculture is having a bad year because of the crop prices, that it's not influencing your organization as severely. And then the marketplace consolidated too. So it just was a natural evolution.
For what it's worth, it's a small world. I was an ag client of Cole McVoy back in the early 80s, so a small world. I think that there has been an evolution in the way acquisitions have taken place in this industry. Back in the days when Lee Lynch sold to IPG, there was a roll-up mentality. And for those of you who don't know what a roll-up is, it's essentially buying lots and lots of agencies, aggregating them, and having the overall results meet expectations, in this case, the stock market expectations. Not a lot of attention paid to the brands involved, the people involved, even the clients involved, because if you did enough of them, you could afford to fail on some of them. It's a percentage game. And that went on, I think, throughout the 90s, even into this millennium a little bit. But these days, and I spend my life talking to buyers and sellers, and I think they've got the message. I know MDC does, but there is a logic round now realizing that the value in independent agencies is the joy of coming to work and the work you get out of people who love to go there. I visited 6 agencies in the last 3 days on the West Coast, and they all have dogs. They all have great perks for their employees, and people are taking the steps 2 steps at a time when they have them. That you need to be able to bottle that, and if there's a point at which, and there usually is a point at which an agency needs to go to the next level, but can't do it by themselves, that needs to be protected, otherwise you lose a lot of that value. And so I think that I'm seeing a change, and to talk about a company that I referred to earlier, but it's not the only one I know, but WPP these days, when they try to buy an agency, they will bring in the principals of 2 or 3 of the agencies they already own and help sell with the communication about what it's like to be part of the group, and most likely, they will compete to be the partner of this new intro. So it's a lot friendly, a lot more sensible, but it's still not independent, not quite the same.
I think from a M&A execution standpoint, when it comes to employees and independent agencies, I've got a relatively good-sized client in the industry that's on the buy side, and one of the biggest challenges that we face when we're acquiring an independent agency is the diverse set of expectations that owners often have, founder owners. So understanding those expectations, far in advance of a transaction from the sell side, and at least attempting to speak with one voice. I know that doesn't always happen, and it's not always possible. But that has really slowed down a number of the transactions that we've tried to get done. So understanding those expectations, understanding really who is calling the shots, really understanding your capital structure going in, and from a intra equity owner standpoint, who needs to be satisfied, what they're going to be satisfied with. And managing that, is a key to getting a transaction done. From the seller's side, speed is your friend on these deals, and the longer a transaction lingers, because of some of these, communication issues or employee expectation issues, the less and less leverage you have, and the more likely you have, the more execution risk that you have that a deal could potentially fail, and nobody wants that kind of black mark on their history. So I think understanding what your culture's like and those employee expectations is certainly key to a successful deal from my perspective.
One thing I want to add on to something that Keith said is sometimes we focus on more of the downside, and there are some really great upsides to being part of an organization that is acquired. I mean, you indicated you got paid more. And you don't lose all the fun, you just lose, things are just different. So in the advertising business, we tend to have people that are very agile, very mobile, moldable. And so if you operate with speed, I do agree with that, because they'll sit and stew and fret and fuss and worry about it to beat the band, and that will actually be counterproductive to doing the acquisition. But as an owner, there are some great advantages. You can sleep at night. Again, I mean, that meat and payroll and having the cash flow, those kinds of burdens are relieved from you. And you get to focus on the things that you love. You get to focus on the client service, because there's a whole department behind the scenes that's taking care of all of that administrative stuff. So while we've had one of our successes, one of our mergers that worked really well, is that the person had a hard time letting go of things at first. And then once we had that trust with each other that, no, things are going to be okay, he actually, he loved it. And he's 75 years old, and he's still working for us part-time, because he now could just focus on the things that he loved, which was the client service aspect. And, you know, we still have somebody who's passionate about the business out there.
Thank you. Keith, we're going to transition a little bit.
think we got a
Oh,
question.
question.
From a smaller independent agency in these M&A deals, do you see a preferred kind of purchasing model as far as like earnouts and what sort of provisions they put in place? Obviously, smaller agencies may be more at risk for losing some of their key clients or something. So are there clawback provisions that are typically used? And kind of how does the seller, or the buyer, I should say, best protect this investment and without putting as much cash as possible into the deal?
Can I start anyway?
don't you start?
There are some variations on the deal structures that are out there, but by and large, they're all fall under the description of an earn-out structure. Because clients can, and sometimes employees can, leave you, buyers want to hedge their bets, manage risk, and so they'll value your business. We're going to talk about valuation in a moment. Pay you part of that money at closing, and that amount at closing is anything from as low as 25 up to as high as 50. In Europe, it can be as high as 70. With private equity firms, it is usually about 70%. And the remainder is paid out over an earn-out period. There are some independent buyers that want very rapid integration. It's difficult to integrate a business while it's still being acquired. And so a 2-year earn-out is occurring in some, but rare instances. Usually it's either a 3-year earn-out or a 5-year earn-out. And the agency now needs to perform. It needs to actually do well enough to justify getting all of the purchase price that was agreed. And the good news is that almost all deal structures are geared so that if the agency grows during the earn-out, they will get more for the business than the initial valuation. If it's flat, they'll get what was promised. If it's down, they'll get less. And so it's incumbent on the seller to be able to see a runway. I can do well in the next 3 to 5 years. And it's also incumbent on the seller and buyer to be a good enough match that chances are that because you become part of this organization, you will actually do better anyway. And so, at least in my experience, my sell-side clients tend to do extraordinarily well when they get a good partner. And the growth goes from maybe 5 or 10% a year to 30 or 40% a year, and that has huge payoff in the earn-out period, or can.
I agree with that 100%. I think one of the key points that I had was going to mention is that from the seller standpoint, you should expect absolutely unconventional terms, and by that I mean an earnout, and sometimes a seller note. Whether that I'd be interested in Keith's input on this. Whether that whether that earnout is a function of what the metrics are about that earnout is important. Whether that's revenue or EBITDA or some other metric, I think I'd be interested to hear Keith's input on that. As a seller, obviously the top line revenue is what you'd like because it's the easiest to track, but and EBITDA is sort of always in the eye of the beholder. And there are much less issues to wrangle about in terms of how segregated the business is, how much allocation of overhead and things like that you're responsible going forward. One of the key issues which you alluded to is what happens with the founders, key employees, et cetera. That oftentimes will be subject to an employment agreement going forward if they leave, and that is one of the issues that we struggle with on every single deal, which is what happens to that deferred or contingent purchase price if a seller leaves and under what circumstances. And so sellers oftentimes want it to fully accelerate if they're let go for any reason. And from the buy side, obviously, if there's a situation where we lose them for any reason that's not the buyer's fault, we would look to slice that back. So that's the give and take on any.
The valuation's typically a multiple of EBIT, basically earnings before taxes and interest. I mentioned earlier that in the olden days, if you like, deals were done on a roll-up basis, little or no interest in how the agencies did in the earn-out. If they didn't do that well, it meant they cost less, which is kind of a weird point of view, actually. That's not the case anymore. And if you certainly can choose the right partner, the chances are these earnouts are very successful. The horror stories that are in our industry are all around earnouts failing. And so it's a very important point that we probably don't have time to get into today, but the right partner and the right timing is what is critical.
So Keith, if you could talk a little bit about the key factors that drive the value of an agency that's looking to be bought by another company, and then related to that, one thing that all agencies could do better that would also improve their value.
I think the last part of your question is very simple. Remember that your agency is a business, not just an agency. It's such a fun job that very often owners of agencies forget that it's a business.
Okay, big ones forget it too.
Yes, and it's a business. But back to valuations, we do lots of valuations for a lot of different reasons, and not always something to do with a sale. We'll do an annual valuation for agencies that have stock option plans or some sort of phantom stock program, and they need, because they're enrolling new employees in on a regular basis, or maybe cashing some out who've qualified to be cashed out, and so they need a valuation. We'll do it for that. We do valuations for mergers where two agencies want to come together and they value each other. There'll be no money changing hands, but they need to know who gets what share in the combined company. We do valuations for our buy-side clients who are trying to ascertain what is the best value to offer a series of targets. And we'll do valuations for our sell-side clients to give them a guideline as to what to expect. But in the end, the market drives valuation. And valuation is expressed as a multiple of profits. It can also be expressed as a multiple of revenue. And because multiples are up right now, more commonly, it is, people are talking about getting 1.5, 2.5, 3 times even revenues for a valuation. In EBIT terms, that's anything from initially 6 times to 8 times as an average. But because of that escalating earn-out mechanism I mentioned earlier, ending up with anything from 15 to 25 multiples. So they can, for successful agencies, be very interesting valuations. And for agencies that aren't selling these stock programs, it's important that they are revalued so employees feel the growth and the wealth and success of the agency. But what are the evaluation factors? That was the question. Growth is the number one. Of course, what sector you're in matters, but if an agency is growing, it's healthy. You think about anything. If you've got a tree in your backyard that doesn't grow, you've got a problem. Sooner or later, you'll be cutting it down or pulling it out. And it's not uncommon for agencies to have trouble growing after a certain point. You know, I think I was about 41 when my arms stopped being long enough to be able to read the newspaper, because I read it on a little thing now. But so I had to buy glasses. Well, so too agencies eventually get to a point where I love running this business, and I love the fact that I know everybody, and I'm nervous about getting any bigger than that. And that's why agencies consider selling. And they're looked at for their ability to grow profitably. They're assessed on the services they provided. Digital clearly is important. A full-service digital agency that is able to handle branding and the creative services that go with it, and the analytical services, the CRM management, the predictive modeling, that will prove its worth and success and able to sustain it. The rounded agency are the most valuable. Within that, those that serve certain sectors like business to business, which are more profitable typically, those clients, healthcare, another area that is generally more profitable than is, let's say, consumer advertising, those tend to improve value. The strength of the management team. The management team is a critical component of being able to keep doing what you're doing. Very quick anecdote. If I ask an agency why they're successful and they say, dumb luck, or, you know, thank you, God, they're probably not a very successful agency in the long run. You need an agency that knows why they're successful and therefore can replicate it. And that means putting the right people in. Having a good management team that are able to help you scale. Of course, people, any agency is a collection of people, and how well those people interact with each other creates the quality of work that wins the business, that keeps the business, that brings in referrals. So one assesses personnel overall. And interestingly, I'm mentioning clients last. Clients used to be much further up the list. But you know, clients are less loyal than they used to be. You know you're going to lose a client sooner or later. So what you need is a team of people and a brand, your brand, that is powerful enough that you can replace a lost client. So they're the things we look at that arrive at a valuation of the business that might be in a range of 6 to 8 to even 10 times profits. And that's how it works. Any questions?
Just to add one thought to that, just based on my experience doing half dozen or more deals recently in this industry, and it's somewhat nuanced, but the due diligence in these types of deals tends to be much more forward-looking than it is in most deals. In many industries, the financial analysis and the quality of earnings that's done on the historical financials is exhaustive, and a buyer will feel like as long as those are valid and good numbers, they'll come in, they'll overlay their processes and efficiencies and synergies and integration, and they'll be able to grow that. And what I've seen, in the deals that I've done in this industry is testing the validity of the projections going forward, and the growth is at least equally as important as the historical numbers.
I agree.
And Ryan,
It used to be that you'd value a business on like 3 years trailing EBITDA average, no longer.
so Ryan, we'll keep on you here.
Question of the.
We have a question in the back.
Keith, you had mentioned that for whatever reason, smaller agencies are more in the mix now as being bought.
Yes.
One of the things that we ran across was EBITDA of a certain size, a little bit more of a going concern. Is there any
Used to
information
be that the big guys would say, unless you were doing about $3 million on the bottom line, we probably can't look at you. Why do they say that? Partly because they spend about $500,000 just doing due diligence and legal, so it seems like you may as well do it on a bigger agency. But there are less big agencies out there.
Yeah.
That's part of it. The other part of it is that I think what scares the big guys in our industry is that somebody in a garage will invent something that will put them out of business. And small agencies tend to be more innovative. They can be. And so one of the things I poke around doing, when I was on the West Coast, I was looking at agencies who've been able to innovate. Innovation is part of their branding, and have been able to productize what they do, which means they get better pricing, better margins, which guess what means they can further invest in doing that. And so actually small, innovative agencies that are on the cutting edge of what matters or will matter in our industry going forward are equally sought after. You may have noticed that almost all of the big holding companies have formed investment groups now. So the Omnicoms of this world, Publicis have just done one. They have people out there doing M&A, and they also have people doing investing. And so they're sort of taking on not a private equity role, more like a start-off investor approach, where they'll buy 20% of 10 companies instead of 100% of 2 companies, and over time have the right to buy the remaining stock. And what it does is allow them to hedge bets, be on the right horse, get more deals done. And according to WPP, who've been at it longer than anybody else, they are actually more successful with their enterprise business, this startups, than they are with their acquisitions.
And as being part of a holding company, just to add on to what Keith says, then we tap into those. They publicize that within our network, and then we're able to tap into these companies and get these cool little, it could be a software offering, it could be a service offering, could be some sort of cool analytical ability that we do not have. And we can tap into them within our partner network. And so it's a really, it's a great relationship both back and forth, because we have something you're always looking for something unique to take to your clients that your competition isn't doing. And so through that, we've been able to use some of those. So, yeah.
Yeah, and MBC, I think, were the first major acquirer to take the approach, by the way, of protecting what you have in the agency, the strength, the independent feeling, the joy of doing work, and yet be part of something bigger. So a combination of, I think, insightful acquisitions into what is going to be the future of the industry and making it a place where it still feels like you have some independence is a pretty cool mix.
And we've appreciated MDC. It used to be when we work with most of the independent agencies, at least doing the, the ad clearance work, trademark, copyright, all those types of things. When one was acquired by one of the big, IPG, Omnicom, usually you lost that client because they had in-house legal, they had in-house functions that they required all their agencies to use. But today, to Keith's point, they seem to be giving these agencies more control over what they can do, and MDC still allows their agencies to make those independent decisions about who they work with and those kind of things. So it's been great for us. We used to pray people would buy themselves back, but that seems to not happen that much anymore.
So Ryan, if an independent agency makes the decision to sell, what are their next steps?
Well, the first step would be to hire a talented M&A lawyer. I think the main thing, and a transaction team is critically important, and I think a team that is nimble and experienced is very important. Understanding, like I said before, who the decision makers are, who's going to be speaking for the company. How many different voices you have and people to satisfy is important, but we've talked about that a little bit. I think one of the decisions is where you're at in the process, whether you're going to hire a financial advisor or not. Is this going to be a situation where it's in this industry where there's a lot of larger acquirers that are actively seeking out buyers? You're much more likely to get sort of a pre-process type of scenario where you're get an unsolicited bid. Hiring an investment banker is a double-edged sword. You ideally want to create an auction scenario where you can pit multiple buyers against each other and therefore theoretically at least drive up the price. The flip side of that is you're going to pay for that. And so many of these investment banks have minimum fees now that are in excess of $1 million. But beyond that, internally, I always say be ready before you're ready. A lot of these, the smaller agencies, what I've seen is, they just don't focus on having sort of all their ducks in a row from an organizational standpoint. And at some point, you're going to get a 14-page kitchen sink due diligence list that asks for all of your corporate documents, all of your customer contracts, and the like. And again, speed is your friend. So the more organized you are, the better the process will go. And any sort of misstep in that process, particularly one that's not known to you, can be a real killer, both on the deal standpoint, from a deal standpoint, and potentially from a business standpoint. I think it's important that that you understand the process. That there's a pre-diligence phase where you get to a number. You move to a letter of intent or a term sheet. There's a post intensive due diligence phase where the parties are negotiating the definitive purchase agreement, and then oftentimes there may be a delayed closing if there's any need to do anything between signing and closing, including getting customer consents. Understanding those types of things, like who are my likely buyers? Are there going to be conflict issues that I need to deal with, either from a contract standpoint or from a political relationship standpoint? Those are some of the things that I would say everybody should be aware of. One of the things that I think we spend, is critically important, and we spend a lot of time dealing with from an economic standpoint on deals is your WIP and your work in process, and how that is going to be valued, and how many hours you've dedicated, both before the closing and after the closing. That, just know that that's going to be an economic issue that's impactful on the deal. What buyers are very, very wary of is valuing a company based on this pipeline of work, and not understanding that, there's a whole heck of a lot of hours that we're going to have to devote to this post-closing that we weren't expecting. We thought you were farther along. So that kind of analysis is critically important. The last point I would just make, and again, I could go on for a whole hour on this, but just understand the communications process. When's the right time to bring who into the loop? Because obviously, managing the communications for your employees once there's a decision to sell is critically important, and can be very, very disruptive and time consuming for those at the top if it's not done appropriately.
I'd just like to add on what Ryan said. Yes, you're going to have to do all of that. But before you do that, you need to call somebody like Keith, or call Keith. And because this is matchmaking, this is our business is very human-centric. And so you need to make sure that you have somebody who comes in and gives you an honest assessment and says, dude, if you keep wearing a ripped t-shirt and jeans, that hot girl is never going out with you. You need somebody who's going to come in and really tell you where your weaknesses and your opportunities lie within your organization to help you get your house in order before you're ready for the in-depth technical information that Ryan's going to give you. So have somebody come in and give you that honest assessment of your business. And sometimes it's hard stuff to hear, and sometimes it's, you might receive affirmation that what you've been doing. But I would start with somebody like Keith before you get to Ryan, so you get a little bit more of that industry niche specialty.
And what kind of timeframes are we looking at as well?
I'll happily respond to that. I have to tell you that $1 million minimum, I wish. I don't believe that's the case in this industry, never mind some others. Typical fees are nowhere near that. But that apart, I think that when to bring a broker in depends upon a number of things. But there's no doubt that on occasion you will be approached by a buyer that you really like. And that you would like to do a deal with. You may even have been approached over a number of years by them, but have not been ready, and now you are. But the problem is the offer that's being made doesn't feel right. And so that's one reason why you would hire an expert to be able to, in effect, inform the buyer that they're way off marketplace and do it authoritatively, and essentially get you the partner you want, you love them, but on the terms that are robust, let's put it that way. The other point I would make is that typically, once you're ready to find a partner to sell part or all of the business, you've got two ways of going. Imagine if you wanted a new driveway in your home. Would you wait until somebody knocks on the door and says, I'm in the neighborhood doing driveways, and pick the first person who knocks on your door, or not? I wouldn't. Typically, anyone who says we're in the neighborhood doing gutter cleaning or whatever else isn't really in the neighborhood. It's just a phone call. And secondly, it's the tallest pygmy. It's the only person I know who's doing driveways this week in my street. So you want to control the process, and that's the reason to have an advisor. And by the way, you need an attorney as well, but you need an advisor who will do what you said, and that is assess where you're at and help you prepare to get ready to go to market. And then we'll identify not 1,000 targets, but maybe 30 to 50 ideal targets that fit the criteria. They can afford you, they're buying now, they're interested in the sector, they fit your cultural expectations. The chances of you, if you became partners with them, you'd do better than if you weren't. It very quickly goes from, our typical list is around 40 targets. We're very big on confidentiality. You cannot possibly risk your employees or your clients knowing you're thinking about a sale until you're truly ready, until you actually can walk into your conference room and tell them you have marvelous news for them, and mean it. You have to mean it. It can't be just about carrying a bag of money out. It is about better situation for your clients and your people as a result of an upcoming deal. And so you narrow it down, you eventually meet with 3 organizations, you get to like each other or not, an LOI takes place, your lawyer helps you with the investment banking firm assess whether or not it's commercially viable, you counter, and you move on. Timeline. It typically takes from deciding to sell a business to it being done 9 months. It can be done as little as 4 months. It can take as long as a year and a half. When it's a year and a half, there are problems. Usually you've got a buyer who is making lots of deals and they have a pipeline. So they're terrific, they get you all excited, you sign the LOI, and then you wait. Not a good situation. Momentum is critical in this business because things happen. You lose a client and they start to get nervous. So you need to keep going. But typically we say 9 months is the incubation period. We can usually beat that.
So John and Lisa, after these 9 months have passed and the closing has occurred, how do you go about implementing the cultural changes and making sure everybody's comfortable paying for pop now or not bringing their dog?
Well, a lot of that work happens up front. So during the time frame, so that again is why somebody because we're in a niche industry, you need somebody to represent you who has niche experience. I get a lot of calls with somebody, they'll call me and they'll say, hey, I'm representing this design firm out of so-and-so, and they've got, their revenue this size and their employees that size. Well, half the times I know who they are, and I'm like, yeah, why would I buy that? I've already got my own design firm inside. So what's happening is they're shopping it around without knowing the industry, whereas Keith will go, okay, well, it doesn't make sense to call them. I'll call this other company because he understands the business. So a lot of that work needs to happen on the upfront before you're even together as an organization. And then I'm a big believer in just ripping off the Band-Aid. So to your point too, you go in the conference room, you mean it. You're like, this is going to be great, you guys. We're going to have access to more resources. We're going to be part of a larger organization. You're going to have more materials and research resources. Michelle and I were talking about that this morning. She just went through a merger. And so there are a lot of upsides to being part of an organization that's going through it. It's not all downsides. There's a lot of great upsides too. And so you need to really mean that. But I believe in just ripping off the Band-Aid and this is what we're doing and tomorrow we're doing this and this is how it's going to go. And not belaboring it and having a period of mourning for the thing that's going away because it's not. It's new and cool.
And what are the typical turnover rates? I don't know if you have any feel of that.
Sorry, what's that?
Turnover rates after?
Like employee turnover rates?
Yes.
In our case, we have not seen, our business already has a high turnover rate. We've not seen a huge increase to when the acquisitions are done well. The acquisitions that don't go so well will have a higher turnover rate.
And
Yeah, the attrition in our industry is a problem, particularly in major markets. There's a scarcity of good people, and so anyway, most employers in our sector have to work very hard at the benefits package, like I mentioned yesterday, the dogs, the freelancers, all the rest of it, in order to attract and keep good people. There are agencies that really market their independence and make a big deal about it, everything from winning clients to recruiting. And so when you do that, some of your people will have come on board for that very reason. Mm-hmm. And I have known clients who've said, I know that John Smith will leave if I sell my business. And my answer is, does John Smith own the business? And if he doesn't, if he's not a stockholder, it does not matter. Because he might leave anyway. What matters is, are you going to create a better situation for your clients and your people as a result of doing this deal? And if you can't answer that, don't do the deal. Because you want to be able to go out and say, guess what? Not only are benefits improved and the chances of working in a Paris office and a Milan office. I have a client, we sold their business, they're based in Toronto. Not only are they growing at 40 to 50% a year as a result of becoming a part of this organization, but the owner of the business, one of the owners of the business is going to be running the Canadian company for the whole holding company as a promotion. And they have people posted to Paris and to Milan who voluntarily went there, just delighted to go. So if you've got real benefits of becoming part of a bigger organization, you have to recognize somebody won't like it. It's okay. You own the business. It is a business.
So as a final question, if we could just go down the line and in 1 minute or less, say what the next, what a trend is in the industry that we'll be talking about at next year's conference. So we'll start here with John.
I'm more interested to hear what they have to say from a trend standpoint.
Trend standpoint, in fact, I was talking to Michelle, or I was talking to Rachel about it. My bet for the next year would be on media and analytics. Media is just a cool place to be in an advertising agency. I mean, there's a lot of really innovative things that are going on out there, and analytics everything has to have an ROI. Everything, we want more and more data and more details. That's just the way that we as a culture are wired. And so those are the two big areas that I see in the next year becoming even hotter.
We didn't talk about this beforehand, but I'm inclined to agree. Digital media, I think programmatic will become respectable. Right now it's going through a difficult period, but it will become respectable. I think that creative in digital media is improving and will continue to improve. I think big holding companies are going to have a difficult time. I think bigness isn't working as well as it used to. And that's because I think we'll continue to see clients spending less money to get the same results through more sophisticated, efficient methodology.
Yep, more targeting using analytics.
I think you'll continue to see the trend continue in a big way of unconventional, less buyers, and continuing to be participants in this marketplace, whether it's the Yelps and Periscopes or really if it's private equity. I think you'll continue to see private equity as they, there's, I think in the private equity world, there's a viewpoint that there's a scarcity of really good targets out there just because they've continued to, drain a lot of the other ponds that are out there, and they're looking to enter new markets that they were a little hesitant to enter before. So I guess that's my answer.
Do you want to say anything now?
I was going to say last
You
chance.
said it. That's exactly what I was going to say.
All right. Well, with that, I think that concludes our formal presentation. Thank you all so much for coming, and we'll be around if you have questions.
Or if anyone has
Any questions, though?
right now.
I'm in a rush.
Two quick ones. Lisa, what is the metric your holding company holds you to? What's the highest and best metric they're holding you to?
It's all earnings. I mean, we're part of MDC Partners, which is a publicly traded company. And so as the CFO, my responsibility is for earnings. My CEO, on the other hand, she is held to growth. So it's an interesting dynamic in that the two of us Christine and I work very closely together and get along really well. But it's because we do have a strong management team. We've worked together for over 10 years. I mean, we're kind of in each other's brains. So it is interesting that they push her on the growth side and they push me on the profitability side. So we're at cross purposes with each other every now and then. Because to Keith's point, we do forget we are a business. Let's face it, everybody in this room who's been in an advertising agency knows that every now and then there's just that cool thing you want to do, and even though it doesn't economically make sense.
And Keith, you talk about a lot of the value these small agencies bring to these acquirers, and that's why they're interested. If they have all those value things, what's the barrier to just keep them from becoming a big guy?
Part of it is it's the skill sets of the owners, the drive of the owners. There is a phenomenon in our business that's talked about. Some agencies are described as lifestyle businesses. And lifestyle businesses are agencies that are big enough and fun enough to be able to attract and keep its people and by and large move along, maybe get to $10 million in revenues and stay there. And everyone's happy. And that's enough. That's all they want. They don't want the stress of borrowing money, maybe increasing their line with the bank to be able to make investments to grow. Any business that is going to grow needs investment. You have to invest in it. And you can think of all sorts of analogies, but just think about one's home. You live in a home, if you own a home, you can either just live in it and be happy, or you can keep it updated, keep the paintwork in good shape. You can put an extension on, you can put a screen porch on. It will become more valuable. Same with businesses. I was with a business in California yesterday morning, and they have gone I won't give actual numbers. They've been doubling in size for the last 4 years, look like doing it again. And it's because they want to double in size. It's an objective for them. It's a business objective. They have decided that being a small player in their area, which is basically CRM, is not going to work. So they have to be big. So they've gone from 30 people to now 350. And they won't double again next year, but still a very healthy increase. It's like make your mind up. You want to grow. If you want your agency to grow 5%, you kind of hope for that. Keep your fingers crossed that you won't lose a client and show up. If you want to grow 30%, you need a plan, because 30% doesn't come by keeping your fingers crossed. You have to have a plan to grow, and if you're going to have a plan to grow, what does that mean? You're going to need more people. You may need a different facility, you may need a different location. You definitely need to look at how you go to market. We haven't had time to be able to look at how agencies are viewed, but there's the obvious, your website, LinkedIn, and every one of your people, by the way, on LinkedIn is looked at, Glassdoor, Crunchbase, Googling. But agencies that are growing are projecting a desire to grow.
Earlier, you talked about how the multiples have kind of been increasing over the last couple of years.
Yep.
And, I had always heard the standard agency multiple was somewhere between 3.5, 4. And so now you're saying that that's probably closer to 6 or 8. And then depending on what sort of different business units you have that earn higher multiples, such as digital marketing and or like software development, how do those kind of lever up or down your multiple as a whole agency if you have different business units that can all pull different multiples?
The multiple you talked about would be for an agency that's really not performing very well. And some people are pretty upset about a 5 or even a 5.5, 6 multiple as being just not enough to be interesting enough to sell their businesses. But inevitably, I'm dealing in a situation where I'm working for buyers who are trying to find the best of agencies, or I'm representing sellers who are running really well, good agencies in sectors that are thriving. And so, the range is 6 to 8 for an initial valuation. But the initial valuation is that first snapshot of the business. It doesn't necessarily reflect the end price, which should be higher. Now, distressed agencies will sell for less. And if you want all the cash up front, 3 multiple might be all you'll get.
Any other questions?
I just caught, I think it was yesterday, an announcement that locally a healthcare firm acquired a marketing agency, a digital marketing agency. Maybe you guys were involved in it, doesn't matter. That, to me, seems to be pretty strange bedfellows. When you look at something like that, does that signal kind of just a blip on the chart, or could this be a precursor to some sort of, trend where radically different type of buyers get into the agency business? Obviously, they want to assimilate them,
Yes.
but what's your
That's a sort of buying a commercial agency and bringing them in-house. And
Yeah.
there's 2 models for that. There are situations where you've got enough work, you can bring them in, and all they do is get to work on your stuff. We're seeing that in retail to a certain extent, funny enough in the fashion industry, technology industry. I hadn't seen it in healthcare, and I haven't seen that note. But it's a decision to in a way, save money by, in effect, you bring a lot of work outside, you think you can bring it inside. There also is a model where you allow the agency continue to be independent, and there's some people doing that, but it's not an unusual model. Hyundai, the car company, has its own agency called InOcean, and they do all of Hyundai's advertising, and that's all they do. But by and large, they tend not to be tremendously attractive to the employees, because it starts to get boring. But it's a model. I don't think it's not a new trend. I don't think it's an accelerating trend.
Right. I think we're good. Thank you.
Thank you.